Hi, I'm Rusty Vanneman, the Chief Investment Officer for CLS Investments, and welcome to the CLS Investments Weekly 3. And with me this week is Koshi Edis, Portfolio Manager. Welcome.
Great to be here, Rusty.
Yeah. So the Weekly 3 this week, we're talking about, the economy. We're talking about some other positive factors and the biggest risk, I think, in the marketplace. And you work in a lot of these different areas, so I figure you're the perfect co-host this week. So, hey, the markets last month, another good month.
Outstanding.
I think just kind of reviewing some of the numbers, the stock markets were up again. The bond market was down a little bit. I think also for the quarter, a lot of the numbers were pretty strong again as well. And for globally diversified portfolios, it was a great week, month, and quarter again. I got one trivia question for you, though. And you know what? You don't know I was going to even ask you this question. So
I love these.
I know. So last quarter... So I know this is a weekly 3, but we just got the quarterly numbers. So last quarter, 10-year treasuries went up about 75 basis points. All right? Mm-hmm. So what did the overall bond market return for the quarter?
I'm going to say 75 basis points?
Nope. So actually,
that would be too easy.
That would be too easy. Actually, the bond market has slight gain. I think it's fascinating. Interest rates went up 75 basis point for 10-year treasuries, and the overall bond market had a very tiny gain. So sorry, you had no idea that was coming.
No.
So, all right. Well, so topics that are coming, of course, is some of the stuff we want to talk about is the economy. A lot of people are nervous about the economy right now, and you actually track some indicators for us, and I think there's some pretty good stories. Talk to us about some of the stuff you're looking at.
So one major thing that I look at is PMIs, which stands for Purchasing Managers Index. Yeah. It's kind of an indicator for the future health of an economy. Basically, there's readings for the manufacturing sector purchasing managers, and they kind of evaluate how many orders they're going to be buying, et cetera. Now, a reading over 50 usually means the economy is going to be expanding, and almost every country that I see a measure for is above 50. So it's looking great. Interestingly, the U.S. is about in the middle. So there's plenty of countries that are actually expected to grow faster than the U.S.
That's interesting because that is one input. Even though the economy is now more even service-oriented, the PMIs are still significant in being sort of a predictor of how the overall economy is going to do. Kind of related to that is the composite leading indicator index, as a mouthful, and that's also pretty strong as well, and suggests that a recession is not imminent. And the LEI has done a really good job, of course, predicting recessions, and of course recessions usually accompany stock market corrections, so that's all good. Okay, that's the economy though, but we really invest in the stock market, and the more important number is earnings growth. You follow earnings growth. What's the story there?
Absolutely. Earnings growth has actually been kind of weak the last few years, but in fact negative almost all around the globe, including the U.S. But this year, there's actually been a fairly strong resurgence. We're talking double-digit growth so far this year, and expectation for yet increasing growth. Now, one really amazing story is emerging markets, which has had really negative growth the last couple of years, and they're in the double digits too. We're talking 15% growth per quarter. That's just unreal.
And the charts look great because it's kind of troughing off the bottom and starting to bounce. I mean, that's usually suggestive of really strong gains in emerging markets. So.
Exactly. But one interesting thing you always point out, that they tend to have even larger growth. So there's plenty of room to run. Just because they're currently at 15% doesn't mean that it's about to fizzle out. There's plenty of room.
And we still like emerging markets, even though they've had a phenomenal run this year and over the last 12 months. That's great.
Love
all kinds of good positives right now. So we don't have to worry about a recession right now. One's coming eventually, but not imminent. It doesn't appear. And there are other good factors right now, too.
Tell me more.
Yeah, all right. So I'll tell you two right now. And one is looking at investor sentiment. There's a lot of different investor sentiment surveys out there, and you can look at what investors are saying and what they're doing. And once again, you follow flows data pretty closely, but I'm just going to talk about just sentiment. And there's a lot of different sentiment indicators, but one is the American Association of Individual Investors, and it's got weekly data going back years. What's interesting is investors are net negative. Now, this data does move around quite a bit. It could change in a week or two, but that suggests that we will have above average returns over the next 3 months, 6 months, 12 months. So I think that's another positive going into the fourth quarter. And speaking of the fourth quarter, the stock market, of course, has really strong seasonal tendencies. And right now, kind of September, October is sort of the weaker time of year. But then right after that, you get November, December, and early part of the new year. Best time of the year for average stock market gains. Now, of course, it's seasonal. It's just plain averages. I mean, like September is usually one of the worst months. Yet the market, the S&P at least, was up over 2%, which is an above average month. So more and more positives.
Gotta love that holiday season.
I know, exactly.
So we've been talking about a lot of positives.
Yeah.
But what would you say is kind of like the main concern out there in the markets?
Well, there's the main concern that's out in the markets, but I'm going to twist this a little bit and think what I think is the biggest risk. And I've kind of talked about this and written about it a little bit in other areas, and of course it is in the weekly 3. But to me, risk is, for an investor, what's going to shake them up and get them off plan? What's going to take them off center, get them out of balance? So what is that? What is that thing? And I think that thing is, believe it or not, the market going up.
The market going up?
I know. I know, exactly. I mean, people always think risk is down, of course, and that is, but really it's volatility in the market surprising you. And 10 years ago and 20 years ago, before the big bear markets, everybody was bullish and optimistic and greedy, and investment managers were called being too conservative. I was called too conservative in both those times. I'm hearing none of that stuff right now. So I actually think the biggest risk, remarkably, is the market shooting up higher, and I think it's quite frankly possible. Most likely not. I think we're looking for a good quarter and a good next 12 months, but there is a chance it could just sort of freak out and melt up higher, and I think that's a big risk to a lot of investors.
I think that's a surprising risk.
Yeah, exactly. Well, great. So, thanks for coming on the Weekly 3 this week, and we'll have you back. And thank you again for your time and trust in CLS Investments, and we'll see you next month.